Hello. In this video, I'm going to discuss order flow and order types. Order flow is something that's pretty simple. The concept is pretty simple, but it can be a little bit tricky to wrap your head around it. So hopefully I can kind of bring some clarity to that. It's something that's really important if you are an intraday trader, if you're a systems developer and you're working on a system that, is in and out of the market really quick for small profits. If you don't take into account the bid and the ask, for example, or order flow, then what you may think is a winning system is very likely a losing system when you go into production. And then the other part I want to talk about are order types. Order types is something that everybody should understand, regardless of what type of trader you are. If you're a long-term investor or you're a scalper in and out of the market, every few minutes. So with that said, I made up an imaginary example, and let's say there's a stock that's trading at this price right now, 125.25. Well, what kind of makes up that price, if you will, is you have sellers and you have buyers. Buyers are willing to pay at, in this example, 125 and no cents, but sellers want to sell at 125 and 25 cents. So there's a separation of the two. And the best way to think of that is if you and I are trying to sell something to one another. I'm trying to sell you whatever. I want to get as much money as I can. You, on the other hand, want to buy it as inexpensive as you can. So there's a difference, there's a separation of the two of us. And that's exactly what's going on behind the scenes. When you see a price print at 125.25, it's really kind of going back and forth between these two prices. And what I mean by that, if we look at another example, say the same stock, if we see this price had traded at 125.25, now all of a sudden it's trading at 125 and no cents. The bid and the ask are still the same. And my apologies, that should not say size. That should just say just bid and ask. It shouldn't say size. But in this example, the up here, price traded at the ask. Down here, price traded at the bid. So unless the bid and the ask move, price is constantly going to just go back and forth between 125 and 125.25. What happens is when if all of a sudden the stock starts to move up, then buyers start bidding up the stock. The bid starts to move higher, but at the same token, people feel like they can sell it for more, so the ask starts to move higher. So there's always going to be a separation of the two. But what's going to happen is, bids are going to move up in price, asks are going to move up in price. Same thing if a stock moves lower, the bids are going to move lower in price, and the asks are going to move lower in price. Trying to say that too fast. But there always is going to be a separation between the two, and that's essentially called the spread, the bid-ask spread. If we get into order types, there's two main orders that all traders, investors should understand. There's market and there's limit. And the big difference of the two is a market guarantees that you're going to get filled, guarantees execution, but it does not guarantee price. Whereas a limit order guarantees price but does not guarantee execution. So the type of order you use is really contingent on what your goal is. If you have to get into the market for a certain reason, then you have to use market orders for all intents and purposes. If you don't have to get into the market, but you really have to get at a certain price, then you use a limit order. And the reason, so if we take this example, a market order, if I want to sell in this market right now, I can sell at 125 and no cents. Or if I want to buy, I have to buy at this price. And the reason being is there's people willing to sell to me at this price, or if I'm a seller, there's people willing to buy at this price. So if I put an order on right now at market to either sell or buy, it's going to fill, it's guaranteed, and for all intents and purposes, it's going to fill at this price. If I went to put that position on and all of a sudden something big happened and the stock moved up or down, well, the bid just changed and the ask just changed. So I'm going to fill at this new bid and this new ask. And that's the danger with a market order, especially in a fast moving market, that you may get filled at a level that's not advantageous, if you will. So now if we take a limit order, so they're essentially off market, meaning that they're not going to execute right now because I want to buy at, in this case, at 124.75, but I have people willing to pay more than I am. So my order is sitting over here waiting for price to move down to the point where now my limit order is at the bid. So in this case, I have to wait. Same thing if I want to sell at 125.50, I'm over here because there's people willing to sell cheaper than me. So now you can kind of understand where I'm guaranteed that I am going to fill at this price, but I'm not guaranteed that it's actually going to execute. Maybe the market comes to right at close, market stopped trading, and my order was sitting over here. It never filled, and that's it. I'm done for the day. I can try it again tomorrow. So that's just the real basics of market and limit. There's more types of orders. There's some other different things that you can do, but that gives you just general overview. And then the last piece I want to talk about, it's called depth of market. And again, just an example I kind of made up here. What that starts to show you for all the different prices, it shows you where buyers and sellers are, how they're kind of positioned. So in the case of this, I see that I have 500, and this is where size is properly used. I have 500, 500 shares want to be bought. That's not necessarily one person. That could be 500 people. That could be 3 people. That could be any number that make up a total of 500. So this 500 shares want to be bought at this price. The 75 want to be sold at this price. As I move higher, I have 250 in this example that want to be sold at this price and 150. So I have a bunch of traders kind of scattered throughout these different prices, and you can get a sense of like who wants to sell and where they want to sell, or the volume, if you will. Down here, I can see that I have 500 shares want to be bought at this price. I have 750 want to be bought at this price. 420 want to be bought at this price. So if I'm looking at this market, this is starting to tell me that there's more buyers under here than there are sellers here. So there's more support here and less resistance here. So all I need is an order to come on for 100, for 100 shares to buy, and I just wipe this out, and now the bid ask just moved up to 125, 124.75. So I just see that I could blow through these positions. If I could, it's with 475. So if somebody came on the market and bought, 500 shares at market, all of these were just sold. Everything here was just sold, and I just moved up. Price just moved up to 125.50. But over here, so that's what 475. Over here, I could sell 475, and I still have 25 people waiting here because I haven't exhausted the bid. So that's just an example of how you can use bid ask spread. Word of caution with that, though. Sadly, the way some high frequency trading happens is orders can kind of get flashed. It's illegal, but orders can get flashed in here to make it look like there's a lot of support and not much resistance up here, for example. And then all of a sudden, this can just disappear right before they're going to execute. And again, it's illegal, but it happens. They just disappear. So be careful with using the depth of market. But it does, like I said, it gives you some appreciation. So that, again, just a quick overview, general understanding, hopefully a depth of market. If you have some questions, post them below, and we'll do our best to answer them. And as always, I wish you happy trading, and I thank you for listening. Have a good rest of your day.